This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com.
Hi everybody, this is Radio Free Wall Street, recorded Monday, August 11th, 2014 from New York, New York. Today I'm going to talk to you about three things. First, the inflation data that came out today from the people at State Street, the old Billion Prices project. I think there's some interesting things to look at there that could throw the Fed for a little loop a little bit later on this year. Then I'm going to look at a couple of indicators that I feature in the Wall Street Examiner Professional Edition Fed Report. One of them shows how bank trading accounts are behaving. That's non-treasury trading accounts, some of the lower quality fixed income stuff that they trade, and also how their investment accounts are behaving and what kind of story that tells us about the current state of the markets. Finally, I'm going to look at my proprietary composite liquidity indicator, which I've altered a little bit in recent days, and it shows a very strong correlation to the behavior of the stock market over a number of years. And whether correlation implies causation or not, to me it's not irrelevant. If the correlation is strong and that gives us information, then we need to pay attention to that information. So we'll take a look at that because that's got a really interesting story to tell. This is an interesting chart that just came out today from the State Street Price Stats Inflation Series. That's the old MIT Billion Prices project, where they survey 5 million online prices every day. And these are prices where there are highly competitive markets, where retailers and other purveyors are forced to compete with one another to move their wares, sell their wares to the greatest number of consumers. And that means that it's not focused strictly on high-end consumption. It's focused across the whole spectrum of income. And as you can see in August, as of August 8th, the monthly rate dropped into deflation territory at minus 0.07%. So on an annualized basis, that would be about minus 1% deflation. This is a good leading indicator of the CPI. That's the blue line up here. The CPI is a little more volatile, but the Billion Prices project, the State Street Price Stats inflation, tends to lead the CPI, so that by the time we get around to the August CPI in September, we could see CPI dropping again to close to zero or less than zero. You have to wonder how Janet Yellen and her cohorts at the Fed are going to react to negative data on the consumer price index. Now, as you recall, this isn't really the full measure of inflation. This is the conventional measure that includes only consumption prices, doesn't include anything that can be remotely considered an asset price, including houses. And even though I think it's at least arguable that a house is not a consumption item, the way they count housing in the CPI grossly understates its impact. But if we look at housing separately and on a real-time basis, the Department of Numbers now has current listing prices up 9.2% year over year. So there hasn't been any slowing in housing inflation at all. That's been a very accurate measure of the trend of housing inflation over time. We've seen it verified by the subsequent lagging data that's released on closed sales. So we know that housing is still inflating at a rip-roaring clip. We know that equity prices are inflated, but since assets don't count and, quote, don't matter, they don't really raise any alarms amongst the policymakers. So while asset prices continue to inflate, housing prices continue to inflate, we see consumer prices remaining under pressure, and that's an indication that the consumer as a whole, the bulk of them, remain under pressure. What does that mean for the markets? Well, we don't know because we don't know how the Fed is going to react to weak inflation data. As I've said in previous programs, I think the die has been cast. They're going to end QE. at least that portion of it where they're buying outright, so that the remaining purchases have limited impact. And when we get to that point late this year, we're going to see an interesting test of how the markets react to that. At that point, if we still have negative inflation numbers, and if the markets react as badly as I suspect they will, then the Fed's going to be faced with a dilemma as to whether or not to bring back some amount of QE. This is a chart that I feature each week in the Wall Street Examiner Professional Edition Fed Report. And I think it's interesting for a couple of reasons. The top part of the chart shows the trading assets, excluding treasuries and agencies, in the commercial banking system in the United States. This comes from the Fed's weekly H8 release that comes out every Friday evening that shows the week prior ended on Wednesday for the aggregate balance sheet of the U.S. commercial banking system. So the top part of the chart in the red, again, is trading assets excluding treasuries and agencies. Now, these are normally fixed income assets. They normally would not include equities to any material degree, but reportedly the performance of lower quality fixed income, in particular junk, tends to have some correlation with the performance of equities, and it's been reported that there is somewhat of a leading relationship there. So this information could be useful in that regard. And we've seen over time, over years, that there's been some correlation with not only the price of the 10-year Treasury bond, which is the yield chart inverted up here, but there's also been some correlation with the S&P 500 off and on through the years. Now, we saw that in 2013, banks sharply reduced their trading assets, and we thought that that had something to do with the Volcker rule. But since the end of 2013, December, the banks have sharply increased their trading assets again. Most of that showed up as a rally in the bond market, but we also saw a rally in stocks this year. Now, at the same time, down at the bottom of the chart, we see investment accounts. These are long-term accounts that don't need to be marked to market. So any increase in these accounts generally would be purchases, added investment. And you can see that with the exception of 2011, that for the most part, there's been a very strong correlation between the direction of non-treasury and agency, non-MBS investment accounts and the direction of the S&P 500 until the beginning of 2014. While we saw a sharp increase in trading accounts that appears to be correlated with this rally in the stock market, at the same time, investment accounts have turned flat, so that it would appear that long-term money is not being allocated to the lower quality securities that are below U.S. Treasury quality. So is this a red flag? Could be. We don't know for sure. We don't have that much history on it. But what it does tell us is the story that the banks are investing less money into these long-term accounts and putting more money into short-term accounts, which also reflect the mark-to-market on the short-term accounts and the profits that they're earning. And these have been rising sharply. Is it a good thing that short-term money is driving these rallies rather than long-term investment money? Probably not. I think this is one of the signs that I'm looking at as an indication that this market is getting long in the tooth and that the bull market is coming to an end. This is my proprietary chart, a composite liquidity indicator that I put together several years ago, and I feature it every week in the Wall Street Examiner Professional Edition Fed Report. In the last couple of weeks, I actually removed one of the components, the reserve accounts, the bank reserve accounts at the Fed. I had been using that as a negative indicator, and I decided, without going into a lot of detail, that the theory that I had based that on really wasn't supportable. And I wanted to see what this composite indicator looked like without that component. So I removed it a few weeks ago. And this chart that you see on your screen is the result of what's left. the remaining components of the composite liquidity indicator, which includes some money flows from the Fed and foreign central banks and in the U.S. banking system, and the trading accounts of the big banks in terms of how they trade fixed income, trading and investment accounts. So, as you can see, going back to 2009, there's a pretty strong fit between the direction of this line, which is in the heavier blue, and the direction of the S&P 500, which is this green line here. Now, the lower below this is the 39-week moving average, not of the stock market, not of the S&P, but of the composite liquidity indicator. And look at how since the latter part of 2012, October 2012, every time the stock market has come down to this 39-week moving average, it has rebounded. Now, again, this is not the moving average of stock prices. It's the moving average of this liquidity line. So it has a little bit of a lag in there. But you can see that the line itself is kind of hemmed in where the tops have been, and the bottoms have stopped right at this 39-week moving average. And that's where we got to last week. So should we be surprised that the market is bouncing back here? Well, on this basis, on the basis of liquidity, which is still in a positive flow, the answer is no. It's not surprising that the market bounces back. But over time, we see the QE is beginning to flatten out here as we get into the last few months. And in the next couple months, it's going to turn even flatter. It'll be almost completely flat. The only influence that'll be positive will be the Fed's replacement purchases of mortgage-backed securities that get paid off from its balance sheet. And that'll be a small amount of money. So this line will go from having a very strong upward slope to flattening to almost flat as we go into 2015. And I think at that point we are going to see the impact in stock prices. We'll probably do no better than a trading range. I wouldn't rule out minor new highs along the way because, Wall Street's going to pull out all of its artillery. If you read the headlines today, the economic news is wildly bullish. The way they paint the stories in the Wall Street Journal and in Bloomberg, everything's got a wildly bullish tilt to try to justify what's going on in stock prices. So there's still the potential to suck the public in a little more, even though I think the dealers are going to be distributing and there isn't going to be enough liquidity around to promote another up leg such as we saw in the last 6 months. I think there's going to be enough liquidity around to keep the pot boiling, and we'll get these up and down moves, and it'll be a bidirectional market, but I don't see anything dramatic happening either on the upside or the downside in 2015. Just want to remind that the Bank of Japan is still going to be pumping. I don't know exactly when or what their policy is going to be, when they're going to change policy and withdraw Abenomics and come back to less insane monetary inflation. But they're pumping cash into the same dealers that the U.S. Fed and the ECB pumps into. So as long as the Bank of Japan is going full bore, there's going to be some excess liquidity in the world financial system. So this line here will flatten out, but there's still going to be enough excess liquidity, I think, to keep the market in a trading range. I think it'll be volatile, but we're going to have to, I think, push the horizon out in time as far as where the real bear market is going to get started, whether the middle of next year, the end of next year. It's just impossible to say at this point. We're going to have to see how the central banks respond to these forces of change as they come along. So that'll do it for today's program. I'll be talking to you next week from my summer home in Canada. And we'll get together again on next Monday, August 18th. Until then, have a great week, trade sane, and we'll see you next week.
This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.